Well, straight to the top story of the day. India strikes back 11 days after the Uri terror attacks that killed 18 Indian soldiers. The Indian Army has responded. It's been the big story of the day. The Director General of Military Operations today said that soldiers across the line of control into Pakistan-occupied Kashmir to take out 6 to 8 terror camps which reportedly act as the base for terrorists looking to infiltrate into the Indian side.
Well, a surgical strike effectively means it was a planned attack on specific targets. While it is not clear if it was airborne or led by the army, what is certain is that the attacks had the nod from the political leadership in New Delhi.
Yes, indeed. And the market was screaming in panic. Jitters were felt across the Lal Street on all benchmark bourses, benchmark indices, the Nifty, Sensex, mid-cap as well as small-cap index crumbled in the session, with the market breadth also opening a yawning gap against the declining stocks. The volatility index spiked. You had the turnover increase to hit one of the largest turnovers ever clocked in an intraday trade. All round, there was panic and there was nervousness on the street.
Tanveer, a correction was coming, and I guess today's correction may have come because of factors which were not there, which market men were not working with. But markets were looking tired. Markets were looking slightly fatigued, closer to 1888.50, closer to 8900. Nifty also was getting jammed. The way I look at things is that look, these are geopolitical crises, and you don't know how to really predict geopolitical crisis, and that is what I think is making market nervous. What captures the mood point today, according to me, is the spike in volatility, the India VIX, and that today shot up by nearly 35%. Now, to put things in perspective for our viewers, India VIX last time shot up by more than 40% was in the month of July and August 2008, when we were dealing with an absolute jam in the financial system, 2008 financial crisis. So nervousness came through. And the reason why nervousness is looking very magnified today is because post-Brexit, we've not had too much of bad news. A one-day splutter because of Fed confusion, but in general, markets have been in a strong uptrend. And this nervousness has come from an unexpected source where you don't know how to calculate it. And it has come at a time when it was not expected. So that really added to that extra dimension of volatility. So up until now, the buy on dip strategy has worked. For those who bought on every decline, they've worked. So I guess that strategy A would be tested today. B, what you don't want to do in this kind of a market for sure is that you don't want to associate with any storytelling kind of in stock. This will happen, that will happen, that. You don't want to buy too much of leverage. And then I would still say that when it comes to small and mid cap stocks, some stocks will offer value. Our experts will talk about that. But in general, you want to avoid leverage. You want to avoid very high beta names. You want to avoid these storytelling stocks where all the lofty, storytellers are telling you FI is 18, this will happen, FI 19 will happen. Stick to reasonable names. This market is giving you a great entry point.
This market is giving you a great entry point once the uncertainty settles, and we'll have to kind of grapple with that over the course of the next few hours as well, perhaps even into the early part of trade tomorrow. Let's get in our power pack lineup of guests over the course of the next 1 hour who will make sense of the markets at this juncture and what the near-term road ahead looks like. Vikas Khemani, President and CEO, Edelweiss Securities, joins us. There's Sandeep Sabharwal also to take us through his fundamental outlook, measuring also the geopolitical tension and its impact on the markets. Kunal Bothra, technical strategist, will help our viewers with trading ideas. Siddharth Bhamre on the futures and options side will talk about the internals of the market. Abhay Aima, country head, private banking group, HDFC Bank, will also put perspective on the ensuing situation. And then, of course, we have Arun Thukral, MD and CEO, Axis Securities. So this is the panel that will give you a 360-degree perspective on the situation that is impacting market sentiment, the border flare-up, which is making the markets jittery.
Now, before we do that and before we go to our guest, Ajay Sharma, Darshan Mehta, Vijay Iyer and Tanya Khosla from our research desk, all of them are standing by. And Ajay, summarize the market action for us in 1.5 minutes. If you have to identify key trends, what are some of the key trends?
Well, Nikunj, clearly this came as a big surprise for the market, and most of the institutional guys we spoke to were not prepared for such a sharp kind of a fall in the market. So there was definitely massive unwinding, forced unwinding of leverage positions, both on the FNO side as well as on the cash side. Cash side, mainly the HNIs were leveraged as far as the mid cap and the small cap names were concerned. That was decimated in today's action. However, when we spoke to the institutional guys, most of them are saying that there's no panic-like situation, no fire exit right now, but the flows, they expect the flows to slow down. The big funds will not rush into the buy. Surely they were already getting jittery about the frothy valuations, and now that the trigger for a market correction has come, probably they will start dipping their feet, but with a lag after observing how the situation pans out. Today the market internals look extremely weak, and they expect at least a day or two more, a couple of more sessions for the market to have negative bias, and that's when they'll reassess the position and start deploying funds. But there is eagerness to buy, but only on decline, further decline from current levels.
Right, Ajay, thanks very much for giving us that perspective on what dealers are saying post-close today. Darshan, futures and options, the internals, what are the cues they're suggesting?
See, the volumes are pretty high, and we ended below the 8600 mark, and we've ended below the 8600 mark for the first time since August 26. And if you're looking at it, before this sell-off actually happened, the Nifty and the Bank Nifty were actually in the green for the month, but that got wiped off. So as far as the entire month is concerned, the Nifty was down almost 0.5%. The Nifty Bank was down almost 1.2%, and the CNX IT was down almost 5% this series. So the monthly gain has been wiped out just because of the big selling that has come off in trade today. Only 4 FNO stocks managed to end the day in the green, so counters like Infratel, TCS, Colgate and Z. But it was an extremely poor day for the high beta counters. So counters like GMR, you have your Sensex, DLF, HDIL, Arcom, Jet, all these counters fell in over 10% in trade. India VIX spiked almost 34% on the back of this sell-off that has happened. The Nifty and the Bank Nifty rollovers are much lower than either last month or the next or the past 3-month average. Call writers are very active from 8600 right up to levels of 9000 in the next series. Put writers are writing in from levels of 8400 to 8600. But it's not been a bad series for some of the counters. Counters like CET, MRF, Apollo, you have Century, anywhere up between 20 to 40%. But it's been poor for some of the counters like Jubilant Food, HDL, Reliance Communication and Idea, which have actually cracked over 15% as far as this entire series was concerned.
So Darshan, thanks a lot for that. For me, the big story today was the VIX. A big spike in volatility. The spike in volatility also coincided with the FNO expiry, so that added that extra element of volatility. But in terms of an historical reference, I think Tanya's got some fantastic data on last time when we saw such a big uptick in the VIX.
Well, what I'm gathering is that the VIX is clearly, as you've seen, up over 35% in trade today. And remember, the VIX is the index that, is actually the measure by which the index volatility is expected over the near term based on the underlying options, actually. So if you look at it in the last 4 instances that we've seen over the history of India VIX, the highest spike seen was in August 24, 2015, where India VIX spiked by over 64%. And after that, we've seen 3 other instances where the VIX has been over 20% plus, which is 6th of Jan 2015. There's also August 16, 2013 and August 5th, 2011. Now remember, if you look at it, this is the second largest spike for India VIX in the last 7 years. And the 64% spike that I spoke of in August 2015 was when the China sell-off happened and the entire Greek crisis as well happened. So clearly, this is, as I said, the largest spike, and the investors and traders within the community are very concerned with the entire scenario, and hence the volatility, it's a very high peak.
All right, Tanya, many thanks for that. Darshan and Ajay, thanks for giving us a 360-degree perspective on the market situation today and sentiment thereof. The VIX, and I just want to highlight this again, Nikunj. It's important because it's the second largest spike that we've seen in 7 years, which essentially also highlights the perception there is attached to this event which is playing out, and the risk that the market sees in it.
Tanvir, with any other financial impact, earnings, or with any macro data, you can put it on the balance sheet, you can put in the Excel sheet, you can calculate the upside and the downside. With these kind of events, it's uncertainty which comes back into the system, and all kind of opinions, all kind of views, all kind of, theories would be floating around. since markets not had too much of bad news this year, they were able to get over the Brexit hump very smartly. An unexpected news which is geopolitical in nature, which could have serious implications, which could be damaging in nature, just tends to spook you, and that's what I think happened. Okay, let's go to our experts and let's get the conversations going both technically and fundamentally. Where do we stand? Has the tide turned for the market? And Vikas Khemani, good evening. I want to start with you. 35% uptick in VIX. The screen is telling me don't take it lightly.
Hi, good morning. Good evening. I think, Nikun, clearly, whenever this kind of unexpected event happens, volatility in the market picks up, and this is nothing unusual. It always happens, and I think typically market bottoms out with the highest, spike in the, VIX. So typically, if it goes to like say 28-30% kind of level, then you will see market might have kind of bottomed out there. So I mean that's just a historical data which I'm just telling you. So I think that's a natural outcome. But I think clearly geopolitical tensions which were unexpected, which have scaled up. Now we have to see what kind of shape it takes, how Pakistan responds to the whole situation. Though currently they have kind of denied that this is not real. It just gives some comfort that probably there won't be any action which can scale up further, but you never know. These kind of situations are really not predictable. So I think markets clearly now has come into a wait and watch mode. Buyers would stay on sidelines and some of the leverage position will start getting unwound. So that I think puts market really on slightly weaker footing in a shorter term. I am saying we have had fairly heavy markets as far as the futures positions are concerned. We have had fairly heavy leveraged loan book market at a market level. So I think you might see some sort of unwinding, especially in light of this event. This is not going to settle in next 1 or 2 days. I think it is going to pan out over maybe few weeks till before you get clarity, and international investors might sit on sideline till then. So I think we are in a now couple of weeks of at least uncertain period, and any move will depend on what kind of actions come about. But having said that, I do believe that from a long-term investing perspective, this is a great opportunity to buy and pick your stocks, because these are the times whenever such kind of events have happened in the past, markets sell off on these kind of opportunities. Events, it creates an opportunity to kind of buy from a long-term perspective.
Right. Fair point, Vikas. Sandeep, however, the question on everybody's mind is that if we saw a panic sell-off in the markets today, then is there more panic in store for tomorrow, start of the new series?
So I think the good part is that today was the last day of the F&O cycle, so I think a lot of the panic would have got built in today. And today was a day when no one was actually buying because there was too much news flow going around. So to that extent, a lot of the froth would have gone out. Now we have to analyze the situation based on the information we have as of now. So the information we have as of now is that India has done a surgical strike. Pakistan is denying anything like this happened, and they say nothing like this happened. It's just cross-border firing. So if that's the situation, and if India is saying that no further action, then I don't see the situation actually escalating. So to that extent, the fears which are getting built into the minds of market participants can get dissipated very fast. On top of that, we have positive global cues where globally the markets are doing pretty well, and in that context, it will be tough for India to continue to do badly.
Okay, fair point. Okay, Siddharth Bamre, technically, what has changed? Do you think the character of the market has reversed, and have we rediscovered momentum and big momentum on the downside?
Good evening. I agree with the observation which Sandeep mentioned right now, that because it was last day of expiry, not many leverage positions would have been carried forward to October, and good amount of positions would have got squared off today, and less number of longs are rolled over. Now, having said that, that doesn't mean that now from tomorrow onwards there would be fresh long positions which would start getting created. What we were observing before this news, that anyways FIs were struggling to form fresh long positions. We were seeing some formation of index short positions, and rollovers anyways were low. So yesterday there was only 51% rollover, and that's what we were trying to point out, that FIs are not rolling over their long positions. So even if you remove this geopolitical thing aside, the situation of market was not that rosy. To add on, this thing has happened. Yes, I'm not. It is quite possible that we may not see such panic selling what we saw today continuing tomorrow and next week, but that doesn't imply that people will start buying again and this market would again bring back that momentum. I believe the upward momentum has not paused; it has halted, and now the market would be more of like both the ways, and preferably more on the sell on rise kind of market, because there are still some positions which are long and these need to be unwinded. So I would remain seller on rise in this market, not for a very big fall, but I think 8500 would be tested, probably will breeze that and go down. So for those time frame, I would continue to hold on to short position.
Okay, Kunal, how bad are the how damaged are the charts now?
Well, Nikunj, I think the charts are definitely damaged. It's not just the index charts which is the key. I think it's the constituents or the mid cap universe which have taken the hit today. One more data point, if I don't know if it's extremely relevant in a scenario like this, but when in the last one and a half odd year, you've seen the volatility spike as well as the advanced decline ratio, which has worsened to almost 1:10. In a scenario, I think we had 3 or 4 such scenarios in the last 1 year. Whether it was a China event in August 2015, or whether we had a similar scenario in Jan and February 2016. So, if you take sort of a like-to-like basis comparison, I think on all of the 3 scenarios, when the index corrected significantly, the volatility spiked, as well as the advanced decline ratio was more than 1:10, worsened to 1:10 or more. We saw a follow-through. I would not say a sell-off, but a follow-through negative reaction coming into the indices. In many instances, there was a correction of almost 4 to 5% further from those levels. So, just about comparing those data points, there could be chance in terms of a short-term correction further continuing. I think the more important part would be the lot of pain which has come across in the mid caps, and I sense that that pain could probably be extended going forward as well. Don't take the markets extremely lightly. Don't be very courageous in this market to try and open positions or be contrarian. So the advice would be to try and short the markets on every rise, and significant downside could probably be seen going forward.
Well, the technical picture slowly is altered, and that is what I think is very, very crucial. Okay, because Wiseman once told me that good news and good prices, they rarely come together. I don't know how much the bad news will extend, but what we can talk about are prices. Another 5% here, would you buy or would you wait for a deeper cut?
So I think Nikunj, clearly, nobody, as you rightly said, nobody can time out the when to buy. But I would say another 5% would be a good level to sort of start looking for. By then, I guess there would be good unwinding of the long position would have happened. Right now, one of the reasons apart from this event will be huge amount of long positions which are there. Markets are fairly leveraged right now. So I think once that settles down, I'm sure long-term money will come in. It will start looking fairly again attractive. So I would tend to believe that around 82, 8300 levels of Nifty, you will see a good level to sort of come back into the market. The froth would have been sort of corrected, especially in mid caps. I mean, you would have seen today a huge amount of correction happen on mid caps. All of us have been sort of worried about the way valuations have panned out in mid caps specifically. So I think by then index might only be 5% away, but mid caps would have probably more correction. So I think I would tend to think that around 82, 8300 levels of Nifty would be a good level to start looking at. Rest all depends, how situations pan out, how worse it gets, how So one can't really in isolation make a particular level of index. But if I were to take again sort of broad thing, I would assume that those levels would be good ones to look at.
Okay, important thoughts coming in there. Arun, come to you as well. Do you think that the panic we witness right now will also spill over into tomorrow's session? How much more downside would you give to the market at these levels?
First of all, today, whatever has happened, the market were very jittery, market were very nervous, and market obviously never likes uncertainty. But if you look at equity by nature is volatile. So you never get a linear return as far as equity investing is concerned. From here, obviously, we have to be cautious. We have to see if either side escalates it. Obviously, there will be more problems. But there will be sideways movement because obviously one should not be very courageous to go and buy. And if you have
Chakri, are you a buyer of the first fall, or this market will give you better entry points? What I'm trying to perhaps understand for our viewers, and I'm trying to understand from our panel, is that is it a time to buy or is it time to raise cash? Chakri, come in on that point.
If you rewind back into the past at various war-like situations, one is the Gulf War, second is the Iraq War, third is September 11th. And if I look back at history when I was in the market during all these various points in time, the first reaction initially there is a huge sell-off which happens, huge as in volumes today are way higher than they were yesterday. That trend continues for a few days and thereafter the volumes subside, i.e. no fresh money comes into the market, wait for the dust to settle before they can assess what next steps to take. And second is when a superpower conducts surgical strikes, let's say US, that's very different from an India conducting surgical strikes into Pakistan. So then it creates that uncertainty whether there would be retaliation, if so when. And so meanwhile, at least some of the international money will wait by the sidelines before again fresh capital is committed. So from that perspective, I would wait by the sidelines before committing fresh capital.
Okay, fair enough. Abhay, let's get your views into the discussion as well. Your reaction to the surgical strikes and more importantly the markets, the mayhem that we witness in the markets today in lieu of that.
See, I think you'll have to wait and see what the reaction is going to be from the other side, because right now there is from Pakistan there is a denial saying that they have not yet or there's a lot of confusion on the other side, to put it mildly. But as far as the markets go, it's an uncertainty which has been created, and markets don't like uncertainty. So the first thing is to try and sell down your portfolio a little bit. But the best thing would be to wait and see how it pans out.
So, Abhay, are you saying that one should not rush into buying the markets?
Yes, right now I think you would wait for a day or two to see what the developments are, what the reactions are. It's preliminary to, there is a lot of speculation as to what the strikes are, how deep they were. More importantly, how is the other side going to react? And after that is clear, only then, one can take a more informed decision.
Yeah, I mean, are we more vulnerable because there are gains on the table to be lost? So, how does one approach the market at these levels?
That obviously makes a difference, because any event is also to be correlated as to where the market is. So if it is, you're touching the bottoms or you're not rallied much, then obviously a negative news will not have too much of an impact. But as you rightly pointed out, if there is people are sitting on gains or upside and there is an uncertainty, the immediate reaction, at least for the people who are on the trading side, is to cut down their risk and exposure, because an event like this, the uncertainty is huge. One doesn't know what it will. Might as well not develop into anything at all and would be forgotten in next 3-4 days. But as I said, it's an unknown commodity, and people would like to cut down on their exposure or reduce their risk.
Sandeep, you buy panic, you make money. It's very simple. But right now, we've seen only one day of selling, sharp adjustment in mint cap stocks. There is no real panic per se. The net change for this year is still positive. We've not gone back to the Brexit levels. Mid cap stocks, if I include today's correction also, I mean, the good names or the obvious names are still a 40-50% this year.
That's true, but I think what we need to evaluate is that are there any reasons to sell in the market, specifically on stocks or companies on the large cap side which are doing well, or specific mid caps which are doing well, which one was waiting that maybe they'll come down and at that time one would buy. So I think all these things need to be evaluated. My guess is that this is not going to last too long unless and until there's a global sell-off, which also doesn't seem likely at this stage. I believe that post tomorrow, as the weekend plays out, next week we'll be looking more at RBI and the data for September, auto sales, etc., whatever comes out. And I think the entire focus of the market will shift, and that will provide a good opportunity for investors. So if investors want to wait out one day, so I think tomorrow might also be light because people won't want to buy before the weekend. But I think from next week we should see some recovery pan out.
Okay, gentlemen, stay on with us. Lots more to discuss, especially how one should be approaching tomorrow's session, as also the coming week in lieu of the RBI credit policy review. But as we take that break, hear out Alistair Newton and his perspective on this burning issue.
I think this is surgical. I think it is an inevitable response from India to recent events in Kashmir. I do not believe it will escalate into something really serious, although that probability cannot be totally ruled out. Maybe 5 to 10% is about the mark. I do expect markets to recover, assuming that there is no further escalation, but it may take a little while given general market jitteriness. And after all, this deeply held belief, to quote an old phrase attributed to Henry Kissinger, India does live in a dangerous neighborhood. For what my thoughts on this are worth, still hold what I've been saying to you and other journalists in India all year, and that is watch the fundamentals, because those are the things which are really important. There's always political risk of some sort in India, or indeed in the Lok Sabha. We've seen plenty of ups and downs there over the past 2.5 years. But the fundamentals are what really matters. The RBI continues to do a good job despite Dr. Rajan moving on. And the reality is that India is continuing to perform better than the vast majority of emerging markets worldwide. So my view is this is probably an opportunity for investors.
Welcome back. You're still watching our special coverage of the LOC strife that scared the markets. It was a dramatic close for the indices, down about 1.5% for the benchmark, and for the broader markets in excess of 3%. And we are still in conversation, Nikunj and I, with our Power Pack panel of guests to make sense of the markets in the near term. Arun, I'll start off with you. What is it that you're advising clients to do? Because there would be a fair amount of circumspection, nervousness on approaching trade tomorrow. What's been your advice?
So obviously we are telling our retail investor to be cautious, and then there are two type of segments. One is trader and one is investor. The traders obviously are more cautious and they will wait for a day or two, and some of the investor who are having cash and who are waiting for some good prices, maybe they can start buying. That is what we are telling them, but we are not telling them to put the entire money at one go. So they will be putting that money in specific stocks and sector what they were waiting and whatever our research has advised. So maybe a staggered manner, and traders to be cautious. Maybe we have to wait if there is any escalation from either side. We will wait for that and then take a call. But right now we are looking at some sideways movement for the next few days.
Chakri, in this kind of an environment where markets were looking slightly tired, liquidity of late has been slightly patchy, global cues at best some would say are okay. Do you think one should not commit too much of money?
I think based on what happened today is there's going to be some kind of divergence. On one hand, developed markets will continue to do their own thing. In other words, they are unlikely to be impacted because of an India-Pakistan situation. On the other hand, you have an India-Pakistan situation which creates some uncertainty for the Indian markets. So in this environment, FII money coming in slows down for some time, but there will, and it depends on how it pans out over the next few days. And over this time, there will be, depending on what happens in the next few days, some amount of portfolio rejig, a move towards greater defensives, greater earnings visibility, and staying away from the leveraged names.
Yeah, staying away from the leveraged names is important because that's where the selling was centered in today's day of trade. Abhay, how will the foreign investor community react to this event? Because, we've been talking about this all day long. It's come at a time, this development essentially, this geopolitical tension has evolved at a time when economically everything has been working in favor of India. It's been seen as a sweet spot within emerging markets. There's a lot of foreign investor interest. Would this derail that sentiment, or even if it does so, it'll be only for the short term?
I think they will same as what we are doing here. They will wait and watch and see what this develops into. If it is just an incident which is underplayed and which doesn't develop into anything more serious, then obviously it is status quo and things go on as usual. But if I was them, I would at least hold back for a day or two to see what this is evolving into, because it could be just rhetorics, but sometimes rhetorics can get out of hand, and that is a fear that any investor has, especially if you are not domestic and you are internationally based. You don't want to get into a situation where there is a possibility of things escalating. So, like I said, the approach would be the same as most investors here have, and even more cautious if you are based internationally.
Right. Sandeep, the scare was really on account of it being a war-like situation. But as we are going through the evening news, it seems like things are settling a bit purely in terms of news flow. The statements are being more measured. There's being more caution addressed in terms of what is being said by both the governments of the respective nations. Do you think that would perhaps settle into market sentiment too when we open trade tomorrow, that we may not see that knee-jerk reaction spill over into the early hours of trade?
I think tomorrow anything can happen, but I think the rhetoric, I don't think is going to go too far, and to that extent the damage to the markets should be limited. And just in one day everyone seems to have turned negative. I think so that itself is not bad for the markets. So I would think that what could happen is that some of these random stock movements in small and mid caps, that might stop for the near term, as those people who bought into these lick their wounds. But for the rest of the market, stability will return, and wherever there is value, I think those stocks are good for buying now. Most stocks have fallen 15-20% from what they were a few days back, and that's a decent opportunity.
Siddharth, what could be a nifty trade for the October series? I mean, October is an interesting month. You will have this festival cheer, you have holidays. We start with a clean slate, a lot of excesses. They've got, unfortunately for the wrong reason, but they've got weeded out today.
Certainly, a lot of traders won't be starting with a clean slate. A lot of long traders would have been trapped. And my trade would be, we have been suggesting to short Nifty from 8,900 plus levels. That position would definitely continue. As far as the new positions are concerned, if I look at the levels and keep this war thing aside and only give weightage to data, which generally I do, then unless and until market doesn't closes above 8,700 levels, I would continue to be suggesting shorting Nifty and one eye at the liquidity positions, which I firmly believe that won't be very easy to come by in next week or so. So this market is not a buy on dips market as of now. Again, when I say that I'm expecting correction to happen, I am not saying that there will be a huge correction, 5-10%. Only this momentum which was there, upside momentum, I think this is over. So we should not be talking about new highs or something like that immediately. Let market settle down, and as market settle down, I think it would go down a bit, probably 8,450, 8,500. And you will get opportunity to short. So Nifty is short. October expiry, as you mentioned, there are a lot of holidays. Call writing would be advisable of higher strike prices. IVs have gone up. Probably IV would go up tomorrow further, and options will become expensive. Instead of doing short strangle, I would suggest, if you are long and if you are stuck in your long positions, it is advisable that you sell 88, 8,900 call option against your long positions.
Abhay, Sandeep rightly pointed out that this news will keep us occupied, war of words, it will get you all kind of headlines, good, bad, ugly. But when we start, but when we move from this week to next week, should we focus on other aspects like Reserve Bank of India, interest rate cut, global cues?
I don't know October 3rd, but I would go with the view that over the next 1 year, contrary to what most people think, I think everything being internationally, no major setback is there. I think relatively it is going to be an easier monetary policy.
Right. There was definitely gloom in the market, but there was no scenario of doom. And I'll tell you, despite a worsening advance decline ratio, which had a yawning gap in the favor of declines by the time we closed trade, you had stocks such as ENIL, Balkrishna Industries, TTK Prestige, Bharti Infratel, Finolex Cables. If you could just run through some of the gainers for the benefit of our viewers, the consumption-led themes, the ones which are particularly going to derive interest on account of the festive demand that's likely to kick in, those stocks did well. And so, Arun, do you think that this would be perhaps a time where one should look at finding comfort within the true blue consumption names again?
Yeah, obviously we are very positive on the consumption theme, and so all these stocks and along with that auto and auto ancillaries. And as you said correctly, that there are beyond this, if we have to look at, if we are out of this maybe in few days, then there are a lot of other good things happening. Whether you look at the competitive index where India has jumped places, and maybe next month when we have this ease of doing business, then again we will jump places. If we look at other indicator like EPFO, they are now going to invest more money. So there are a lot of positives also around. But now, because this is a major thing, a major news which has come, and so if you look at on the opportunity side, yes, there is a decent opportunity, and if as I said earlier, if the things don't escalate from here, then there will be a lot of opportunities, and our investor, that is what we are saying, if they are not over leveraged, if they have cash, maybe this is the time, and then they can go and buy certain good stocks and accumulate them.
Kunal, what is the good news in this market? I mean, it's easy to talk about, momentum has got broken, channels have got tested, but where is the good news in this market?
Well, I think, Nikunj, the good news could be a bit far away. I think, as I said earlier, with a lot of examples in terms of data points, I think you need to have the market settle down. The volatility has to subside significantly. I think the key over here would be that from now on, if the volatility doesn't subside for a day or two, you might have bigger gaps in the opening, any which ways, depending on the kind of expectations or the news which builds up. So from a trader perspective, I think it's going to be a very difficult scenario for the next couple of days. You have to let the volatility subside. I think that is where you would see a lot of opportunities building up in terms of trading. But I think at this point of time, it's a bit difficult to call when and till to how much extent would that happen.
Right, Sandeep. Consumption, pharma, the defenses act as your comfort food when one is stressed, and that's how it's going to play out with the markets as well. So, yes, there will be largely, risk off for most sectors, but for the low beta names, there's going to be buying interest. So you have consumers, you have pharma, you have perhaps even IT as a contrarian play.
Yeah, but Tanvi, actually, I don't believe in this entire thesis which is getting built up. Because that means that we are in for a prolonged downturn. I don't see a prolonged downturn unless and until we have a global downturn. It doesn't seem likely. So I think let's just couple of days pass, and then we'll see how it's playing out. And I think even the stocks which held up today, I think that was more because where there are no punters. So those stocks held on. I think where the too much of speculation was there, those sold off. So I think that's how the market will be maybe for a couple of days. But then the thesis of the market should not change. I think it should remain the same.
I just want to put this point across, to all the panel members, Nikunj included. Yes, so this is a local event, and the market will have to grapple with that reality over the course of the next few days. But going into October, isn't it seeming like the road ahead looks a bit tough and uncertain again, given that we are staring at the US presidential elections? That just adds to how the binary event would impact market sentiment. We've seen that with the Brexit vote as well, which took the markets by surprise, and we came off it pretty quickly. But even so, wouldn't this risk-off mode extend out? So it started off locally, but wouldn't the global sentiment play up for the Indian markets where we would adjust lower? Nikunj, you want to start off with that, your perspective?
Tanvi, my sense is that we've had a good clean rally in August and let's say part of September. So it may not be such a clean move in October. US presidential election, referendum in Italy, the complacency in global markets, if I refer to the CBOE VIX, it's quite amazing that when we are staring at some market moving events, how come volatility is so low? So I think we will be in for a lot of up and down, lot of event reaction. It's just getting too cozy and too comfort. There is cheap liquidity. Central bankers have got the back of everyone. There's liquidity which will take care of all the imbalances. I think that's a crowded trade. And Chakri, that's my biggest concern. This cheap liquidity trade is now getting a crowded trade. So whereas I continue to remain bullish, but I think that it's not going to be as easy or as one way as what July and August have been.
You're right in the sense that first all the leverage positions get knocked out. The HNIs stay by the sidelines for some time. 3, they try to find defensive stocks, and then the search begins. And in that process, the markets just tread water. You wouldn't really see any big upsides. And then after that, hopefully this whole thing just turns out to be a flash in the pan. Then you're back to normal and creates an enormous buying opportunity. But until then, I think we will start to see new sectors emerge even after this whole dust settles down. And I think we need to start thinking what those sectors will be.
Sandeep, your take? Because you had Brexit happen and then the market saw a knee-jerk reaction. We saw that reaction correct itself over the course of July, August. There was a bit of headroom that the market also covered, so premium to the lows or rather the pre-Brexit levels of that came by for the market. And now we are again getting into that zone of the upside seemingly getting capped. I don't know how do you read into the situation, because this is going to be another event that will influence market trade.
I think this again of this argument of the upside being capped, I'm not very sure of that. So I think these things will play out. I think we are in a bull market. This bull market has a lot of legs still to go. Corrective moves will always happen, and that's an opportunity for investors who have cash or who have generated cash or who are getting more cash. And this entire argument of foreign investors also being on the sidelines or selling in India, I don't just believe this thesis, because I've been in this market for so long and I've seen it through various such events, Cargill, etc. Foreign investors don't sell through those events because most of the investors in India are long term. They have seen India over so many years, and they buy more from the perspective of long term rather than what will happen next week. What will happen next week bothers the traders, the F&O operators and the F&O players, and they are getting hit, and they might get hit a bit more, but nothing more significant.
My biggest sort of overlaying factor here, Chakri, and Arun, you may also want to comment on this one, but first Chakri, is that ultimately what is the downside protection in any market is valuations, and 18 times not that cheap. The stocks which are good, they are nowhere close to the historical lows. So in event of any sharp global reversal, local reversal, local nervousness, global nervousness or something else, where is the margin of safety?
See, what's happened today in our opinion is basically, now this is a very short term thing and then things are back to normal. Even otherwise, in terms of PE, right now the PE looks high because the earnings are low, because earnings are forward earnings. The earnings cycle, recovery cycle has just begun. Now in this case, at the worst, what happens? The earnings recovery cycle gets pushed out by another quarter or so. So it doesn't change the overall thesis that this market, the Indian market will recover because the earnings are forward looking and corporate balance sheets, etc., are fairly strong. Now what it then does is, now you will probably find new legs of support in the sense of various other sectors. Now some of the defense-related sectors, infra sectors, those sector and some of the irrigation sectors, they all in somehow autos, like the M&M makes defense vehicles. They all now will garner extra attention, and so there might be some EPS reject. As a result of that, what goes off on one side comes off on the other, and barring this uncertainty, you have an EPS which is forward looking. So, the current PE which looks high is because of depressed earnings, and therefore, we should look at, let us say, FY18 outwards.
Okay. Fair point, Chakri. I just want to get in my colleague Vijay Ganeshan Iyer as well. Market regulator SEBI has also been put on high alert after the Indian Army conducted surgical strikes across the Indo-Pak border. ET now learns that SEBI has sought a report from all stock exchanges on their preparedness if there is an escalation in the tensions. Vijay, what are you picking up from your sources on this matter?
Market regulator SEBI clearly is on a high alert, particularly the way markets behave today after the news came in of the surgical attacks that Indian Army did across line of control in Pakistan occupied territory. So clearly market regulator, what we gather, has written to the stock exchanges and asked them to submit a detailed report on trying and understanding, is there a requirement to put in place more checks and balances in case things go out of control or the tensions between India and Pakistan escalate. The whole objective here of market regulator SEBI is to take precautionary measures, and that is why it's speaking to the exchanges to ensure all the back-end infrastructure is in place. The surveillance has been increased, and also the settlement processes needs to function in case of the volatility gets increased in the market, because at the end of the day we all know it's sentiment that drives the market. So any negative sentiments of things escalating between India and Pakistan could have its own impact on the equity markets, particularly the way it behaved today. So clearly market regulator SEBI is just on a wait and watch mode, and they are clearly taking precautions and are in touch with exchanges to ensure all systems are in place, the surveillance is enhanced, and to ensure any volatility would be handled in a proper manner in the Indian equity markets.
I'm going to get closing comments, and let's get like literally a one-word answer from our experts. Sandeep Sabharwal, you've been bullish, but will you continue to remain bullish irrespective of the events?
Yeah, I was bullish, then I was skeptical, then I thought some correction should happen.
Right now, what is your stand? Bullish or bearish?
Bullish only.
Okay. Arun, bullish or bearish? And I'm talking about next 3 to 4 months.
I am bullish, yeah.
Chakri, are you with the other two panelists, or you have a different view?
Yes, I am bullish. Only thing is just that the earnings cycle gets probably postponed by a quarter or two, doesn't really impact the long-term story.
So, Pamela, in the morning you were bearish, you got it right. Do you think it makes sense to remain a bear?
So, in next 3-4 months, probably I'll change my view 10 times. I cater to traders. So, my answer for coming week is that I'm bearish. Bearish in the sense seller on rise. Data change, I'll change my view.
Kunal?
Yeah, I think very similar. I think from a short-term perspective, the view is bearish.
Abhay, if you got Abhay, he also has a perspective on especially what earnings recovery can do for the markets. Abhay?
Like I said, barring an incident like this, I think the things are looking pretty good. I think all that the government has initiated will start bearing fruit. So the normal thing that one used to hear, oh, government hasn't done this, government hasn't that, I don't subscribe to that view. Yes, there have been no big bang reforms, but I think the changes that are being made are effective. It's just that, like I said, since it's not big announcements, it's not satisfying a lot of people. But the effects of that, I think one is already seeing, both on the corporate side, definitely on the development side. If you look back 2 years back, in terms of infrastructure, whether it was the power sector, whether it was the surface roads, or whether it was any of the infrastructure, things were looking, even banks for that matter, things were looking quite bad. Compared to that, I think we have come a long way. Like I said, the effects of that will unfold over the next 1 year. Well, I think they've all stabilized now, and as far as the results that went past, have been slightly better than expected. I think that trend will continue. So, like I said, if you see pickup on the basic, infrastructure industries, that is going to reflect overall. And I hold the same view as I do for the infrastructure industries for the rest of the corporate sector over the next 2 quarters. And with the interest rates likely to come down, things are looking better than most people would expect.
All right, gentlemen, thank you all for joining us. It's been a very engaging conversation, and I guess the market messaging or the panel messaging is very simple. In the short term, you don't know, it's about sentiment, but the medium term outlook for India does not change. In a bull market or best of the bull markets could correct, but when you buy on days like this, when you look back, you would be a very happy long-term investor. And before we wrap the show, one more data endorsement that no one panic today. Institutional data both from FI and DI was on the long side. So maybe this is that buying opportunity or that panic buying opportunity but institutional investors were waiting for.
Oh yes, indeed. For our viewers out there, FIIs on a provisional basis bought close to 3,400 crores and domestic institutional investors bought close to about 1,600 crores. So that just gives some sense of confidence. Very tricky. But let's say like leverage positions were getting wound down. So perhaps it's the speculators were getting out.
Algorithms were at play. It coincided with the FNO expiry. Typically when there is the first...
Leave the computers.
No, someone sold, let's be real.
But thumbs up coming in from the FIs as well as the DIIs in the market session. And in fact, on that note, as we wrap up this show, the special edition, hear out Robert Parker of Credit Suisse, who also keeps his long-term conviction with the Indian market.
Investors are always very sensitive about what we call in our jargon geopolitical risk. If, however, this is a cooperation almost between the Indian government and the Pakistani government to deal with terrorism, and it is, as the news says, surgical, then the impact is likely to be short-term in terms of the impact on the currency markets or the equity markets. And one has to see what the reaction from the Pakistani government will be. But unless there is a serious escalation, I am assuming that the market reaction that we're seeing today will be fairly short-lived, and that as we go into, the next week or two, it's going to be issues like the global economy, the Federal Reserve, the earnings season in India and elsewhere, which is going to dominate markets. The problem, as you know, I've got with the Indian market is that a lot of good news is discounted in that elevated valuation. So, I think the comment one can make is very positive on the outlook for the economy. The outlook for earnings growth, I think, is probably fully discounted in the market. So I don't think we're going to have a major market reversal. I think we could struggle at these rather lofty levels. If you ask the question, are we going to go through 30,000 on the Sensex 30? I think that's going to be a stretch over the next 6 months or so.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.